Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, July 27th, and this is the weekly market update. The disclaimer, as usual, anything that you hear or see on this podcast or video is not to be taken as investment advice. I'm not a registered financial advisor. I cannot give you individual investment advice. Please do your own due diligence. The information provided here is for entertainment and informational purposes only and is not to be taken as investment advice. Okay, before I get started, again, please just make you aware, if you're new here, help out the channel if you enjoy this content. Like the videos, share them, comment. Also, check out the show notes because I have a free weekly email that I put out every week that basically is an amalgamation of all the things that I'm looking at or reading that week, or videos I found interesting, or podcasts, articles, what have you. That's free. I send that out every Monday or Tuesday. So go over to Substack and sign up for that. And also, if you are interested to understand how I'm specifically investing in the themes that we're talking about on here, I have a paid newsletter, the Actionable Intelligence Alert newsletter. It's a monthly publication. That's also on Substack. There's a link to that in the show notes. So please avail yourself of that if you are so inclined. Okay, let's get started. So pretty interesting chart here to start off thing. S&P 500 at initial claims. We've talked about the unemployment rate being the last leg of the stool holding this economy up. I think that's probably a little bit of an overstatement, but you get my point. And so a lot of people out there saying that we're going to have a recession, we're not going to have a recession, hard to know. What I would say is I just wanted to point this out because we're all about probabilities here and looking at things in the past and seeing if similar setups are developing. And what we have seen in the past is when unemployment goes up, or initial claims, basically unemployment, the S&P 500 has a tendency to drop. As you can see, uh, when unemployment's going down or initial claims are going down, the market is rallying. So something to be aware of. Again, somebody will put in the comments, correlations, not causation. But what I'm saying is in the last several recessions, we've seen a similar setup. So if we do see initial claims, we do see employment getting weak, I suspect that you will see the S&P pull back. Now, the last couple of weeks have been volatile. We've talked about the fact, I have talked about the fact that I expected the market to be volatile. You really can't, you can get all the market commentary you want on a daily basis about what caused this particular move or that particular move. In the end, we're facing, at least in the US, one of the most overvalued markets of all time. If you choose to play in that market, that's certainly your prerogative. If you are making money in that market, that's good for you. We'll see if that continues. I prefer to buy things that are undervalued. And there are undervalued situations in this market, but also around the world, there's just tremendous bargains if you look outside the US. And I would prefer just to buy things that are selling well below book value, or selling at, there's tremendous companies that you can buy if you're willing just to do a little bit of work and look overseas in areas that are just being totally ignored. There's a company that trades in Hong Kong that is kind of a conglomerate, for example, that's selling for the same share price that it was selling for in 2006, and the company is multiples larger than it was. So these are the type of things I'm interested in. Not everybody's interested in those because they're not sexy, they're not entertaining, they're not flashy. But I think that you'll find, when, for example, the conglomerates in South Korea are very cheap right now. Something you might want to take a look at, and you might want to look at when Warren Buffett was buying the Japanese conglomerates about 5 years ago, and why he was doing that and what happened there. So it could be a similar setup, but I prefer to buy those things that are very cheap, relative to things that are very expensive. I don't like buying things that are expensive that everybody else is buying. It typically, the research shows that just doesn't work out in the long term. In the short term, you can make money, but you have to get off that bus. And it's typical of the people that are doing that they don't get off the bus. They just think that it will continue forever. So keep this in mind. Here's an example. This is from Bank of America. There's been no rotation from U.S. to international equities. That's just I've rotated. I'm out of the U.S. Uh, oil field services is still viable. Some other things are still cheap, but you know, this shows the U.S. versus global equities. I mean, guys, this goes back to 1950. You've got the Nifty 50 bubble in the late 60s, early 70s. You've got the internet bubble. Here's that's one. Those things traded to one standard deviation of over, or close to it, and this was this was a these were bubbles, and you see where we're at now. We're three times the U.S. is three times more expensive than the rest of the world. I mean, doesn't mean it can't be four or five or six times more expensive. I'm just saying. I think that charts like this always end up one way. They roll over and come back down. And I would rather be on the other side of this in international equities when they get repriced upwards. I mean, I've been harping on this for a while. Nothing's happened. Nothing happens till it happens. And so um, people are enamored with the current zeitgeist around AI and data centers. But what I found interesting is even some, very famous and vocal investors and people involved in the space are like, okay, well, how do you actually make money with AI? I understand how it's going to put lawyers and accountants out of business over the next 10 years, or at least that's what I've heard. But, it's kind of funny because I'm not sure they have it perfected yet. So, I mean, with the amount of money going into it and the expectations, this just reminds me so much of the internet, of the original internet bubble in the year 2000. It's just the same type of, and if you're not around for these bubbles, you could read about them in books, but you have to be there and actually experience the euphoria, the rationalizations, the psychology. And so anyway, when I see these charts, I just have to show them to you. It's just like so far out of whack. You can't, I don't know how you can buy this. Now, if you're a trader, that's different, but there's how many successful traders are there on the Fortune 500? Not that many. And so what are insiders doing? People that know the stock the best, the people that are in the management, they're dumping stocks at rates not seen in a decade. And so, insiders have taken a sharply bearish turn. Percent of publicly traded corporations experiencing net buying from corporate officers and directors, it's below 20%. So, I mean, relative to the average, it's about, half, down 50%. So, yeah, the people that know it best are selling. So, but again, the shoe clerks and the you know bleacher bums, they are always last to the party. They're the last ones to hear about it, and they can make some money. Some of them have made some money, but now they're top investors. Just ask them, and they'll tell you. So this is another chart from Bank of America. I thought it was interesting. I put this T-bills and chill. You're still getting over 5%. Nobody's cut rates yet in the US. So you're still getting over a little bit around 5% for T-bills. T-bills and chill. You see like long-term bonds, hardly any money. This is just the private clients of Bank of America. This isn't the market as a whole, but I still found it interesting. You're seeing the bets on 2 to 10 years increasing, but not like super way out maturities. But I still think this is, will they cut in the end of July? Bill Dudley came out and said they should cut now. I heard Steve Hanke, another economist, saying they should probably be cutting already. They're going to get this wrong like they get it wrong. They being the Fed, they'll get this wrong like they've gotten the other things wrong. And so I think, as the money supply contracts and they hold rates up higher, then you'll see a panic once you start getting a whiff of deflation, and they'll start cutting rates. And that's why you get these. If you go back and look at all the rate cutting cycles prior, you'll see that once they start cutting rates, it goes very quickly, because usually they held rates too high for too long, and the economic news starts being very bad, or you have some type of banking crisis or some kind of liquidity crisis. I thought that this was interesting. We're talking about how the consumers are squeezed. I guess now the Treasury Department Internal Revenue Service has created a ruling that employees can now withdraw up to $1,000 from their 401ks without penalties if the money is needed for emergency expenses. The Department of Treasury and the Internal Revenue Service has issued final regulations updating the required minimum distribution rules, reflecting changes made by Secure 2.0 that impacts retirement plan participants, IRA owners, and their beneficiaries. The reasons for an emergency expense include medical care, funeral expenses, auto repairs, any other necessary emergency personal expenses. So again, if you don't even have a rainy day fund, which most people don't have, then they're going to let you just go, dip into your retirement funds. Well, up to $1,000 penalty free. So you can, put new tires on your car or what have you. So I don't know. This is just another indication to me at the margin that things aren't what people say they are, when you have people having to dip into their nest egg to pay, which should be emergency expenses. Everybody should be able to put $1,000 in cash together. So, but most people can't. We know that. And I don't know how many people that can't put $1,000 in cash together for an emergency actually have a 401k or an IRA. That'd be interesting to know that also. So this is an interesting tweet from Jesse Felder that this is a question that we've been pondering, and somebody came through from Bloomberg with this. Says commodities rally through a recession, and it shows this is the days around the recession. Move starts. This is the start of the recession. This dotted line, and typically commodities prices will fall going into the recession. Then as the recession starts, they go sideways, and then they move higher, then they rally through the recession. Well, why is that? Because the central bank will start cutting rates and printing money. And so that, going into the recession, that's what we're seeing kind of. I think some of the commodities are becoming weak now. Copper, oil prices, oil's down again. I think Brent is just barely at $80 a barrel. Copper's down to like just barely above $4. We've seen weakness in um, uh, uranium, other things. So this could be another indication of another recession uh, that's getting ready to start. I personally think we may already be in a recession. Do I think it's going to be like the great financial crisis? Likely not. Do I think that the Fed's probably going to start? We know, they're pretty much going to start cutting rates for sure in September. The question now is, do they have a 25 basis point cut later next week in July? We'll see. Right now, the odds are that they don't, but you never know. But this should give you some solace. It's impossible to call these recessions, but you can kind of see what happens. There'll be an opportunity, I think, to when one does come, to buy, because the inevitable money printing that's already started around the world a year ago, where we had a net cutting of central banks, not most, but more banks cutting than raising rates, started last year. So we've already got that trend in place, and I'm not that worried. Can things drop? Yes, you just buy more. And it was kind of, that's one thing I do like about social media, because it does give you an idea about sentiment, and I'll get into that in a minute. But as I can show you here, this goes back to 1960. So, of course, nothing's exactly the same. This is just the mean. But again, you would expect to see that, right? commodity prices becoming weaker as you move into the recession. They move sideways to the start of the recession. The central bank starts cutting rates, and then commodities start rallying in anticipation uh, of more demand or a lower US dollar or a combination of all these different intermarket relationships. So yield steepening, that's when, right now you have the 2-year that's higher than the 10-year. So you have a inverted yield curve. As that moves to being uninverted, where the 2-year is less than the 10-year, which is the way it should be, the further you go out, the rate should be higher because of the more risk you're taking. And that will happen as the central bank starts cutting rates. You'll see the short end of the curve will start coming down. Doesn't necessarily mean the further out maturities, they'll come down also, but they won't come down as much, and you'll see an uninversion. But typically, that's been good for gold. That's the point we're trying to make here, and so we can expect that to happen again. I think this is from Crescat Capital, this particular chart, but we're getting ready to see that. We're right on the verge here, as you can see. We're just waiting for these rate cuts to start, and then this thing will move up. And I suspect, gold's sniffing out that situation. I think that's why we've seen new highs recently. But, think nothing goes straight up. Things pull back, digesting the gains, and then, prepare for the next leg up, if you will. Things take time. I thought this was interesting. This is a hedge fund positioning in energy is at decade lows. I think Josh Young posted this. I mean, this is crazy. It's like hedge funds are like have no exposure to energy commodities, right? They're totally bearish on them since 2022. So again, we've seen it fluctuate quite a bit, but this is quite the outlier that we haven't seen at least in the last 20 something years. So it makes you wonder, are we due for a turn here? And I think again, depending when these rates get cut and the money printing really starts in earnest, we've talked about before how that works. Then it won't be instantaneous the day of, but once we establish the fact that we are in a rate cutting cycle, people will be anticipating lower rates. And that's when I think you'll see this shift from, these Mag 7 tech stocks into resource stocks and value stocks. So this is interesting. Somebody posted this chart. So this goes back to 2019. You have uranium miners, the spot price, commodities in general, U.S. equities, U.S. bonds, U.S. dollar, and their returns. Everything starts indexed back to June, basically, of 2019, 5 years ago, basically. And you see how uranium and uranium stocks have outperformed. And the thing I want to point out is it was kind of interesting. I've really seen some like almost like suicidal type tweets on X recently. One guy got on there and he was like, all of you uranium bulls need to get on here and give us an explanation what's happening. What's happening? You're digesting 300% gains that happened. I mean, that's all. Uranium bull market's not over. You just got in probably. This is what happens. People buy here or here or here, and then it goes down, and then it's like, well, how come this isn't doing what I want it to do? With no history, where were they back here? Where were they back here in 2015 when I was started to talk about this? Or when were they buying in 2017 and 18 when you could buy things for 3 cents on the dollar? It doesn't matter if things go down 30% to me because I'm up, when you start way back here. And the thesis continues to get better. Now, you're not going to get the same gains that if you would have bought back, 10 years ago, 8 years ago. You're simply not going to get those gains, but we're still nowhere near the end of this bull market. And I look at things fundamentally. That's how I look at them. And so you can see the outperformance of both uranium and uranium miners for the last 5 years relative to just about the other major, everything's shown right here. This should explain it to you. And so this could drop, this could drop even further in half, and you'd still probably be above, where the rest of these competing vehicles are, equities and bonds. You'd still be outperforming. But if people buy here, this is the thing they point out all the time with these stocks like Apple and Amazon. I remember I never bought those stocks because I don't know enough about technology, right? It's outside my circle of competence. That's why I don't go there. I'm not a momentum person. I guess I could play it that way. I just, I have nothing against these are great companies with great products and they've made people a lot of money, but I have no expertise there. I cannot do anything there. And so, but this is the thing you'll see, like when Amazon or Apple, there's stories there. I haven't looked at the charts. You can go back and look, but when these things went down 80, 90% a couple times, and yet they were still up thousands of percent on the long term. It's the same thing that I've pointed out before. When this uranium bull market's over, you're going to look at an overall long-term chart that's going to span, I don't know, 10 or 15 years, and you're going to see the trend line go from the lower left to the upper right. And there'll be drawdowns in there. We've shown these charts before. And yet you have these guys, I demand that when the uranium bulls, you can't find one now. They're all, okay, well, it depends where you buy things, guys. It depends your positioning size. People actually, unfortunately, hear something, they go 100% into a theme, and then it drops 30%, and then they get upset at everybody else. You did that to yourself. You didn't follow position sizing. You don't put all of your money into one theme, no matter how good the theme is. Okay. There's going to be some guy that did that. When this is all said and done, he's going to be a centimillionaire. They're going to have him they're going to do a thing on him in Forbes or something, or in a Wall Street Journal. This guy in his basement made $200 million in uranium stocks, blah, blah, blah. It happens every bull market. You're not going to be that guy. You're not going to be that guy. And I've told people what to do. And if they're still interested, if they've done their work, I get emails all the time. What should I buy? I cannot give you personal financial advice, and I wouldn't even if I could. I don't know you. How do I know what your temperament is? How do I know what your knowledge base is? Maybe you just started investing in stocks. You probably shouldn't be putting your money in uranium stocks. It just depends on what your knowledge level is, your temperament, your emotional and psychological Q quotient. And we've talked about all this before, the psychology of investing, which is lacking amongst most people. That's why they're unsuccessful. Who goes on Twitter and blames everybody else for their own decisions? Because some uranium junior that's never going to produce a pound of uranium isn't doing what you want it to do. And somehow that's the uranium bros' fault on Twitter. That's out there. What I don't see is hardly anything. That's the kind of sentiment that I look for, that tells me, okay, well, there's some of the stocks I have on my buy list, I probably should be nibbling at, because when the shoe clerks and bleacher bums are, getting ready to perform ritual seppuku, and you don't see any of the uranium bulls on there pumping, then it's probably, close to being washed out. Again, nuclear is the future of this world, whether you like it or not, unless you have another Chernobyl or 3 Mile Island or something. Otherwise, it's full speed ahead. It's just going to accelerate from here. And there's not enough fuel. People say, well, nothing's happening with the spot price. I saw another guy, the spot price does matter. Another guy, the spot price doesn't matter. Guys, this isn't like trading an open outcry like on the NYMEX for crude oil. Okay. It's done with just a few people that know each other, and everybody's on vacation. It's summer. That's why there's not a lot of action going on in the uranium market. Okay. Notwithstanding the fact that, what are people going to do? People are on vacation. People, after Labor Day, when people come back to work and everybody's back, then they'll start reaccelerating things. Plus, probably legal departments at utilities have probably said, wait a minute, let's get a ruling from the, Energy Department on this Russian uranium ban. Can we get a waiver? What have you? There's a lot of other things. It's not open outcry like in the oil market where the news is digested immediately and reflected in prices within seconds. This is not how it works. The supply demand deficit is there. It takes a while because the market is so opaque in the way that it trades and the way how long the fuel cycle is and all these other things. That's why the prices don't react immediately. But nothing's changed fundamentally. The only thing that's changed fundamentally is that the fundamentals have gotten better. These things just aren't doing what you want them to do. I've had to give this speech several times, and I will continue to do it. So, people can have whatever view they want. Let's just be frank. Most people, and I sell a newsletter, and I make a lot of money selling a newsletter. I'm going to be honest, okay? And I think I put a good product out. I don't shill. I don't, mining companies call me all the time and want me to put them on, and I don't do all that, okay? I tell what I think is the truth, and I put out there what I actually put my own money into, okay? And if you're just going to just listen to what one person says or this person says, you have to do your own work. And I will say this as a newsletter writer that does this for a living. Most of you people should not be investing your own money. You should just figure out what the world economy is. Each country, the US is 22% of GDP, China's 21%, and you should put your money in ETFs and just sit there and then rebalance it once a year. That's what most of you guys should do. You should just go down to Edward Jones, tell the financial advisor to put you in ETFs and balance you in accordance with the way the world is. Okay? And you'll get 9 or 10% a year. And you'll do very well over a 30 or 40. You'll have a lot of money when you retire from your job, which is what you should concentrate on, because most people don't have the emotional or psychological makeup to be an active investor. It's just that simple. Plus they don't have the skill set to I've asked people, they pitch me something. I mean, regular people, they know what I do. So people say, what do you think about this? Well, how did you arrive at that? They can't give you the elevator pitch. I'm not talking about, you don't have to break out an Excel spreadsheet and walk me through a discounted cash flow. All you got to do is give me the elevator pitch, why you think this is a good idea. Most people can't do that because they heard it from somebody else and it tickled their ears, and then they picked up their phone and bought it and didn't think about it. And then when it goes down, then, it's somebody else's fault. So anyway, these are the facts. We're not in dispute. I guess you can pick it from whatever period starting point you want. That's another argument somebody will make, but this gives you an idea, okay? You buy on dips. You buy when sentiment's bad. We're in a bull market. You should be buying right now. If you're down 30%, I've talked about your favorite food is being on sale 30% off. You should buy more. That's my advice. Most people won't do it. There was an article by, that'll be in the free email this week, of one of the hedge funds. The guy was explaining in more detail why this is the way it is. It's basically just psychological makeup. It's kind of like that Mark Sellers. I think I put that I think it's on the Substack also. I did put a reference to that article. This guy named Mark Sellers, I believe he ran a hedge fund. It's called Sellers Capital. I don't think he runs it anymore. This discussion was kind of similar to the other talks that other famous investors have given, and this was given to a selection, or not selection, to a bunch of Harvard MBAs, people that were getting their Harvard MBA, some of the brightest people out there. And the title of the discussion was, "So you want to be Warren Buffett?" And explains why you won't be Warren Buffett, even these Harvard MBAs. Doesn't mean you can't be a good investor, but a lot of it comes down to the psychological makeup. And one of the arguments that this Sellers guy made was this is already instilled in you by the time you're 10 or 11, 12 years old. And if you don't have it by then, you're not going to get it. That doesn't mean, again, you can't. It's the same thing with sports. I've had this kind of wondering about this for a lot of years. Is this where people just are born with this ability, just like some people are born to be able to hit major league pitching, or some people are born to run fast, or what have you? And I think that is the case to a certain extent. That doesn't mean you can't become a very good golfer. If you take up golf and you practice and you try to hone your skills, doesn't mean you can't improve your golf game and become a above average golfer, but you're not going to make the PGA. Most people are not going to be on the PGA. Okay. It's the same thing here. Just because, I still think it's possible. Like I said, most people should probably just put their money, go to a financial advisor and say, hey, buy me a bunch of low cost ETFs and just break it up, whatever weight that the different areas of the world are in, Latin America, Africa, Asia, North America, blah, blah, and break it up and put like so much in the S&P based on the percentage of the US, and then rebalance it every year. That's all. And then take the dividends and buy whatever has underperformed. And then just count on mean reversion and the ascent of man to compound your wealth over time. Again, most people simply do not have the time, the ability, or the emotional makeup and psychological makeup to be successful active investors. And this whole thing around this whole uranium, I mean, uranium is very volatile. Okay, somebody wrote an article and sent to me about uranium stocks really aren't that volatile. Okay. Okay, good. I didn't understand the article. I had no idea what they were saying. They're happy. If you're listening, you can come on and explain yourself, but they're pretty volatile. So this is the problem with junior mine. The other thing that I find amusing, you guys are playing around with penny stocks. Most of these companies will never produce anything. Okay. They're just promotions. That's what they are. Now, if you go to a conference, a mining conference, and talk to the management, some of them actually believe they're going to produce something, but most won't. There may be one or two mines that come on each cycle. That's it. And so this is why you buy the physical metal, but that's not sexy. That's not going to get me the 5,000% return that I read about that happened, in the last uranium bull market. That's not going to, visions of sugar plums. Well, we're here to compound wealth over time in with as little risk as we can. So we buy undervalued things, and when they become a little bit overvalued, we sell them. We sold a lot of the juniors that we had that we did buy for, 5-10 cents a share. We sold a lot of them already because they have no prospects of ever building a mine. Building a mine, taking a project and building them. I've pointed this out before, guys. And so this is how this thing has to work. Okay. You should be buying at this point, the physical uranium. I mean, a lot of these stocks are overpriced anyways. Even the producers, they're overpriced. If you want to do, analysis of the companies, Cameco, Kazatomprom, that are actually legitimate producers, they're overpriced. But nobody wanted to buy Cameco, and it was $8 a share or whatever it was, 5 or 6 years ago. All right, I've beat up on people enough on that. It is what it is. This cycle will continue. The next thing that comes up, this is what I'm saying. I mean, nobody wants to talk about Hong Kong real estate companies that are selling for, a third of book value and have 8% dividends. And no one wants to buy that. No one wants to buy South Korean conglomerates that are selling at, PEs of 3 and 4 or whatever, half a book. No one's interested in that. No one's interested in these Japanese small caps that many of them have more assets on their balance sheet, cash and assets, than the stock value, and that how the Tokyo Exchange and the Ministry of Finance is trying to get these companies to wake up and being more shareholder. No one wants to talk about this stuff. Everybody wants to talk about uranium and flash and pizzazz, because that gets the dopamine going. That's it. Buy Greek banks. They all just got released. They're so overcapitalized, like the rest of the European banks. They're the last ones now bringing up the rear, where they're being told that they can now start doing share distribution or share buybacks and dividends. Is anybody buying them? No, no one has it. Why would I do that? Well, because they're cheap and there's an inflection happening. People ask me, what are you doing now? Greek banks, South Korean conglomerates, Japanese small caps, mid caps. But you got to do work. Eventually, people will be talking about them and I'll be selling them and moving on to the next thing. But that's it. So I like when I come upon these charts to show them, I'm bullish on gold. I'm very bullish on gold. Again, most people should just buy the bullion, buy silver bullion. If you don't have a lot of money, you can dollar cost average. You can just buy what you can buy. That's what I have done throughout my life. When it was cheaper, just stack, they call it, I guess. But again, people want to buy mining companies that, even though mining's a terrible business and very difficult, and even under the best managements, all kinds of things go wrong all the time. But this is what's happening. We've talked about before why this is happening. Why is this happening? Because there's a multipolar world coming into play. It's funny, I talked about the Great Game or the Great Chessboard, whatever it's called, that book by Zbigniew Brzezinski, which I haven't fully read, but I do recall that one of the things that he feared, and I think this book was written in 1997, I think, or 94, I can't remember. I think it was 97, and he was a big foreign policy poobah in the U.S. Brzezinski. He was really came to fame under Carter, but he was kind of like one of the original neocons, I guess, Kissinger guy and all that stuff. And it's interesting because he said one of the things that would be the worst for the U.S. would be this emergence of a Chinese, Russian, and Iranian kind of like tripariate, if you will. I don't know. He didn't use that term, but axis of evil, whatever you want to call it. But that's what you have now. I was just interested. They just commissioned the railroad that goes from Russia through China, parts of China, and into Iran. So now you have this, using part of the Caspian Sea. So all this stuff is happening in the background, and nobody's paying attention. Instead, we're having assassination attempts on a former president who's running for president. That looks like there's all kinds of shady stuff going on with that. Shady stuff going on in the DNC with the removal of President Biden running and this emergence of Kamala Harris, who's never won anything. And just a lot of shady stuff. And everybody's telling me, I kind of make it akin to this whole Team America puppet show movie, USA, USA. I mean, this is what's happening in the background. Okay. And this isn't just the only country. And what are they buying instead? You know, gold. What are they doing? They're setting up their own World Bank type situation, BRICS Bank. They're setting up their own organizations, right? As this multipolar world emerges. I mean, what's going to happen, for example, this will be a feature of the newsletter in August that I'm going to write. Somebody wrote in me and said, well, I don't understand why you buy the companies you do. You don't explain it. Well, when I put a company into the portfolio, I explain why I do it. Okay. I don't give monthly updates. So if you're just coming on as I should probably do a better job of indexing the previous articles, but I don't. But we do explain our thinking in the newsletter. I write extensive, multi-thousand word commentaries just about every month about this stuff. And one of the things is, this multipolar world, people are not paying attention. Whether you like it or not, I mean, just because of the virtue of the fact that these people have a larger population. I mean, BYD, for example, this is one of the examples I want to give, builds a car. I think it's called the Seagull. It's an electric car for $9,700. Do you think that the United States is ever going to allow that car to be imported into the United States? Of course not. You just had Ford, I think, announce that it lost $5.4 billion on EVs. So we have to protect those auto workers that are making, $50 an hour with wages and benefits. Even if they put 100% tariff on the Seagull, it would take it to 20,000 to get it would wipe Teslas off the map. Okay. But these cars are going all over the rest of the world. And so I read an article where somebody kind of used the example of what I think is going to end up happening to the US. It's just going to keep shrinking. They're going to put up tariffs. We're not going to make America great again. We're not going back to the 1950s. Those advantages coming out of World War II, they were squandered by your leadership, so-called leadership that enriched itself. You're not going back. Now, there are some things that we do lead in, and there's some things that we'll do well in. But I just don't see it. Building chip factories in Arizona, can't get anybody to work in them. I read an article the other day where I think that they were building a shell factory for shells somewhere in Europe, and they had to bring Turkish workers in because nobody in Europe knew how to operate new machinery. I think it was the same thing here in these chip plants in Arizona. They had to bring people over from Taiwan because none of the morons that live here know how to do anything. And so, you got 1.4 billion people. You have, you have a government that will get behind its industry, that looks out for its own self first. The exact thing that's missing here in the US and in Western Europe, where the globalists are concerned about themselves and the rest of the world instead of their own countries. And you've squandered the lead that you had. You squandered all the advantages. And so even if you put 100% tariffs on this BYD Seagull, and they brought them in here for 100% tariffs, they'd sell them for 20 grand. They would be flying off the shelves. They'd sell millions of them if you want an electric car revolution. Of course, the auto companies in the US become like what? Like Swiss watchmakers, as the Japanese, Koreans, and Chinese, as electronics collapsed watch prices through the 70s, 80s, and 90s, they just became smaller and smaller, making more high-end watches. Is that what you're going to end up having here? Boutique car makers of luxury vehicles only, or something like this? People say, well, they'll never, China will never, you know, be able to do this, or the Russians can't do that, or these people can't do that. And then you wake up and they're doing it. It's the same thing with I can't pronounce how do you pronounce it? The Chinese phone maker, Huawei, I think it is. They make a phone now that's comparable to the Apple phone. It's substantially less money. So this, why do you see this multipolar world emerging where they have these advantages? They have mostly homogenous populations, mostly are going to pull the wagon and again. I'm not saying this is the best system. I'm not saying that that's going to be a better system for everybody in the world. I'm just telling you what's going to happen. And there's no reason to be holding treasury securities when all you get is bashing of China by everybody in the West. And that's why I think, you have these conglomerates that sell in Hong Kong, or why Chinese stocks are so cheap. I don't think China's going to. The only way you lose on this deal is if the U.S. does rug pulls you like they rug pulled you on Russia. And that is a distinct risk. They've already demonstrated they'll do it once. And they're already starting to go up the sanctions escalator with China. And most people don't even understand it yet. So I think, buying Chinese stocks or stocks in Hong Kong and Singapore and some of these other places is like buying the Dow in 1982 when it was selling at like generational lows. It's the same situation. Do I think China's has problems? Yeah, every country through its development has problems. But I just think that Asia, again, I've said, if it was 1800, you moved to London. It's 1900, you moved to New York. In 2000, where'd you move? You have to move, it's the Asian century. But I think gold is going to move higher as becomes a higher percentage of central banks, especially the BRICS nation central banks reserves. Again, I point out before the chart, I don't have it listed this week, but the chart where I showed that 1 point central bank gold as a percent of central bank reserves back in the 60s and 70s was like 60 or 70%. Now it's down to like less than 15%, but it is climbing again. And I think gold's going to reemerge, especially in the context of the financial chicanery and malfeasance that's going on with these central banks and these governments. Here it is. More central banks plan to add to gold reserves. No sellers plan. So this is the previous 3 years change in gold allocation of central banks. Actually, two banks were actually selling gold. Now you see that it's not a major change, but nobody's selling gold. No central banks are selling gold now, or plan to over the next 3 years. And more now are going to start increasing. Now it's up only two. It shows this change, but I think that's going to increase over time. And why is it? I mean, here's something from Game of Thrones. They source this from Bloomberg. I don't know if this is total debt, if this includes all countries, unfunded liabilities, regardless, what is going on since like the year 2000. You've had like a 10 times increase in world debt. This is crazy. Total financialization of the world economy. $300 trillion or going on 250, 225 something trillion dollars in debt. Well, actually, this is higher now. This only goes up to 2022. It's crazy. And there's only one. This is why, some of the conspiracy theorists, I don't disagree with this. What would be one way to really get out from under this, to have the excuse to print the money or to have a reset, global reset or whatever, a world war? This is why there's such a big push for war, in my view, because under the canopy of a war, you could get away with anything, right? Hey, those bad Chinese and Russians and Indians and Iranians and, Team America puppet show, they're bad, we're good. And, we had to wreck the dollar because, to save our democracy. Too bad, I don't think people are going to swallow it anymore. People, you could get away with that when you only had 3 television networks and 2 or 3 major newspapers. The internet is full of all kinds of commentators, all kinds of people. The minute one of these morons in government gets out there and says something, it's on tape, and then they contradict themselves. People are showing that, but yet there's still, unfortunately, 30-40% of the population that no matter what the state says, they're lock, stock, and barrel right behind it. Even when they go upside their head, they still, I told you about those awful overweight middle-aged white women from Wisconsin or whatever. They showed all that stuff about Joe Biden. They said, "Oh, we're fine with that. We're voting for him." That's your democracy. So we like to show this comes out monthly. GMO's forward return forecast. Nothing's really changed. This is going to fluctuate, every month based on valuations. But again, where are the forward returns, at least in equities, in international, emerging and emerging value? Where's the place not to be? You're looking at negative returns over the next 7 years in U.S. stocks. Why? Because they're so overvalued. It's working out. It'll continue to work until it doesn't work. I get it. When the ability to compound wealth, you walk down the street and you find, $100 bill, that doesn't make you a good investor. If you get lucky, you get lucky. Can you do that across several market cycles or through a decade? Can you compound wealth? That's what I'm interested in seeing. If you can do that, then I want to study how you did that. Anybody can get lucky. Anybody can get caught up in a bubble. All right, that's it for this week. I appreciate the support, the viewership, the subscribers, and we're trying to turn out some more content. Been a little bit tired here the last couple days, but we're got a lot of ideas, so we'll keep the content coming. Again, sign up for the free emails that we send out from go over on Substack. Everything's in the show notes. Links to that in Substack. If you want to understand the newsletter, what I'm actually buying, you can check that out also. There's a paid version of our newsletter on Substack also, so you can avail yourself of that. All right, that's it for this week. We'll talk to you next week. Thank you.